2%, in NCR 2.25%, in Bangalore ranging in 2.75%. So why would you invest in residential real estate for 2.5%? Because there is a maintenance, there is a lot of asset management expenditure over a longer period of time. So if you really are an investor who is looking at a cash flow, then I don't see why you would not invest in commercial real estate as long as you are able to mitigate the risk. You spoke about 3 plus 3 years, and the fact that once the building gets vacated, it's very difficult to lease it out, and it always happens when the cycle is in the downturn. But you compare a specific building which is not getting leased out with buildings which are fully leased out. Normally, you would find those buildings which are fully leased out, even in the worst of downturns, they are good buildings, grade A buildings, being developed by reputed developers and with excellent category of tenants who have been profitable, who have been growing, or at best stagnated, not growing and not cutting down on the manpower. And there are ample examples. See any micro market, there are buildings which are fully leased out, and there are buildings which are finding it extremely challenging to even lease out 20 to 30% of the space. So I think the choice of the building after you have selected the location for yourself and which tenant you are investing in is extremely important. Also, don't take the risk of thinking that you can perhaps buy a vacant commercial building and then you can perhaps lease it out over a period of time. Because commercial real estate is very technical. It's not, in India, because all of us tend to invest in real estate, there are no REIT market. Traditionally we have invested directly in the real estate. We tend to think that we understand real estate. But commercial real estate is a very different ball game. And if you want to invest in developers who are willing to take the asset management risk, asset management responsibilities, and developers who choose their tenants very carefully, even if they are giving them a few rupees less of rental. So I think it's an investment objective. Both asset segments, whether residential or commercial, have their own risk and reward situations and scenarios. But it's extremely important to play it out carefully while mitigating the risk. So the location, again, as I told you, the location, the tenant, and the building specs are extremely important for commercial real estate.
Hi, my question is to Rajiv again, and it's related to commercial rentals again, but not on a rental risk perspective, but more on a property itself under risk. You know, when you give it, say for example, ground floor of a residential property is given to a bank. After 9 years, even that is not vacated. So, you know, the property value itself vis-a-vis the renter, and you know, I have met a lot of people who are not too keen in rentals, be it commercial or residential. They say we would like to keep our property vacant or rather invest in land, you know, maybe freehold land. And so rental, for that matter, is out from the, they have, you know, multiple properties and they can give it on rent, but the risk around the property not being vacated at an appropriate time. So how do we mitigate that risk? And do you believe from a, you know, from a layman or not layman, or from an investor perspective, is it really appropriate to get into a commercial real estate from a rental perspective, and how best that can be mitigated? That is one. Two, is the risk is reduced when it comes to residential? To some extent it looks yes, because you are dealing with the individual rather than a big corporate. And it has the other side of the coin also, that since in commercial it was a large corporate, the risk was relatively low because there are people of a certain degree who are there on the board. The other side, the third question also relates to commercial is, you said there are developers who are like on the verge of insolvency and they are keen on taking amount at relatively higher rate of interest. But I mean, don't you think so? It's too risky because you yourself said it's on the verge of insolvency and you are giving them loan. So what would, you know, be the fate around that? Or are there enough mitigation strategies in terms of bank guarantees or whatever? So if you can just elaborate on that.
I'll take your third question first. Well, I agree with you that there are a lot of developers, including some of the large developers, without taking any names, who have been, whose balance sheet have been extremely stretched, and they have refinanced cheaper cost loans with higher cost loans. My friend from Milestone keeps doing that all the time. Uh, but I mean, there are risk mitigation strategies, and yes, the risk of default is very real when you are taking a loan at 25% annual interest. Then the risk of default is extremely real. The expectation in the mind of the developer is that perhaps the cycle is going to change. Perhaps he's going to see the cash flows. Perhaps he's going to see the sales coming through, and he would be able to repay those loans. But what happens if the cycle doesn't change? And that's why there are risk mitigation strategies in terms of creating collateral covers, taking exposure on projects which have already seen the price points established. For example, talk about a particular project where the structure has already come, which is already 50% sold. The cash flows are going to accrue over a period of 3 years. Buyers have already put in 20 to 30% of what they would have invested with the developer. So they are not going to default. Buyers are not going to default. It's just the timing of the cash flows which are going to accrue over the 3 to 5 year period. So you escrow those cash flows in a separate account, and you create hard collateral covers. And if they are default, those collateral covers, which would be multiple times, X multiple times your principal investment, and your cash flows would help you secure the risk. So that's the answer to your third question. I've forgotten what was your second question.
First and second were related to the commercial and residential in terms of renting out, not the vacancy risk, but the property itself under risk. The property is given on lease to a corporate or to a bank for 9 years, 10 years. After 9, 10 years, it's not getting vacated. So you believe there are enough, what I was saying, because I met a lot of people who are not keen at all in investing in commercials from a rental perspective. So what is your take from as a professional, and how do we mitigate those risks?
Well, there are situations where after a period of 9 years, assuming you spoke about a particular bank leasing out a ground floor space in a particular building, and then perhaps not vacating or not intending to vacate. Not vacating is different from not intending to vacate. And it's because the rentals have moved on in the market, and the rentals that this particular bank might have been paying is just 45% because there's an escalation of 15% every 3 years. So over a period of 9 years, maybe 50% over a period, because of 3 escalations, 50% of the original rentals, while the market rentals might have moved up 2x or 3x. But then, and that's why there are watertight lease agreements which comes to protect the landowners or the building owners and also the investors like yourself. And normally in such situation, when a particular company is not intending to vacate, you will actually get into a rental renegotiation. You may not get the market benchmark rentals, but you would get much more than what the contract, because the contract has already expired, what he had intended to pay. So rental renegotiations comes into play, but in my experience, I haven't seen situations when somebody who was not intending to vacate the building did not get into rental renegotiation, because don't forget that he's carrying the business disruption risk by trying to do that. So he will eventually get into rental renegotiation, and so I don't think that is a real risk as far as the investors or the landowner or the building owners are concerned.
I think we have just time for one additional question. There's a question there.
My question is for Rehan. This institutional trading platform that you talked about, how popular is that, as in how many trades have happened, and is there any qualification criteria for the deals to go through on that?
So the platform is fairly recent. It was announced in November 2013. I believe about 6 companies have listed on the platform. More so will this soon. And what are the criteria for getting onto the platform? I mean, there's a disclosure criteria, and then there are certain criteria, like I said, that AIF fund has to have invested in you, certain corpus. The company can't be, over a certain number of years old. I think you can't be more than, 20 years old. Or, there's a whole list of criteria. I mean, you can Google it. There's a comprehensive list, but we looked at it. It's fairly simple for a legitimate, private company to get onto this platform. The criteria is quite light. And all the big consultancies, PwC, KPMG, etc., they all have a lot of information on this to help you get onto the platform. It's fairly straightforward from what we saw. We're trying to push a couple of our startups to get onto the platform. So it's not very tedious.
But the existing investments done by earlier VC funds, those investments can also be sold?
I think so. I think both VCF and AIF are included. Yeah.
Thanks so very much. Thanks Naveen, Rajiv, Rehan, Radhika and Ashutosh for a very engaging and a very comprehensive discussion on a wide array of topics. And I think given the way the regulation is shaping up, given the way the industry is shaping up, and given the way the investor sophistication is shaping up, there's a lot more to look out for. This industry has potential to become very, very meaningful in the years to come. And thank you, ladies and gentlemen, for having the patience of sitting through the last session of what's been a rather long and tiring day. Thank you so much.